Hello and good morning, everybody, and welcome to the Daily Energy Markets podcast. It is February the 15th, 10:30 UAE time, and oil is trading a little bit softer in Asia this morning. Brent crude oil at $81.25 a barrel, down a little bit, less than 0.5% on the morning trade. Down a little bit through the week, giving up some of the 6% gains from last week. Let's kick off this morning with Dr. Carol Napoli, CEO of Crystal Energy. Carol, lovely to have you back. Your thoughts on the direction of travel at the moment. The markets seem to be a little bit stuck neither here nor there, even though the context, still a raging war in Gaza, equity markets and other financial markets soaring to record new highs, but oil left in the corner all by itself to do not very much. Your thoughts on the direction of travel at the moment?
Good morning, Sean. Good morning, everybody. Well, you're absolutely right in terms of there's so much action happening on the ground in terms of geopolitics with wars in Europe still ongoing, the war in Ukraine. And then we saw some escalation over the last few days. And also Gaza still ongoing. We also saw attacks and exchanges of fire between Israel and Lebanon. I cannot imagine such a scenario happening maybe 10 years ago without seeing panic across markets, particularly in oil markets. But today, this is not happening. And this is a reflection of different dynamics, particularly the changes in market conditions, that there is, relatively speaking, too much supply despite the cuts in OPEC for too little growth in demand. The economic factors, the macroeconomic outlook is still weighing down on the global economy, but also on oil markets in particular. We see positive signs, but does not mean that everything is growing rapidly. And that's the problem we get from the news. So sometimes you get some positive signals from the data, but you cannot change the whole outlook based, for example, on 1 month of good data. We have to wait to ensure that we are on the right path. The economy is performing better, at least in the West. China, I'm still very cautious about the outlook for China because these structural problems are not going to dissipate overnight. So on balance, we understand why. When we look deeper into the market dynamics, the economic outlook, we can understand why the geopolitical dimension is being not overlooked, but it's not having the same impact as it would have in a tight market.
Neil Atkinson, former head of Oil Markets Division at the International Energy Agency. Neil, we saw this week OPEC release its monthly report, and we had comments from your former colleague Fatih Birol, the head of the IEA, both telling us a very different story. OPEC plus still forecasting a 2.2 million barrel a day oil demand growth for 2024. The IEA, at least Fatih Birol this week, saying no, it's only 1.2, and there's plenty of supply around to cover that. Your thoughts, about the difference between those two, 1 million barrels, and which one do you think the market looks to be guided by at this point?
Well, I don't think I can remember a time when the divergence between the outlooks for something such as oil demand growth between the two agencies was so wide. I really don't remember it. And I'm afraid the only thing I can think of to explain the difference between the two is that they are both talking their book. The IEA is in the peak oil demand camp, which, according to them, is within sight, i.e. before the end of this decade. And the OPEC Secretariat almost find it hard to conceive that oil demand could ever possibly peak. So they're in the onwards and upwards continuous growth in demand as far into the future as you can reasonably forecast. The IEA think it's going to peak in less than 5 years' time. And I think to some extent they're talking their own book. If I were forced against a wall and asked to pick between one of the current outlooks, the big one from OPEC, the lesser one from the IEA, I'd beg to be allowed to say, well, it'll be somewhere in between, because I don't think it will be as low as the 1.1 million, whatever it is, 1.2 the IEA's got. But I certainly do see no justification for a real gangbuster increase that the OPEC Secretariat are talking about because of the, as Carol was alluding to, the structural economic problems in China. A lot of the post-COVID rebound in demand has sort of happened. We still have a lag in aviation. So I think the answer probably lies between the two agencies, but there is a serious discussion to be had about why the agencies are so diverse in their outlook.
Mehmet Ogutu, Group CEO, Global Resources Partnership, and Chairman of the London Energy Club. Mehmet, one of the things, as Carol mentioned, obviously geopolitics in the region, conflict in the region, and obviously in Europe still. But one of the question marks in the region has been, can the sort of rapprochement, the new sort of coming together that we saw pre-October 7 still survive, Saudi, Iran most notably, but also Egypt and Turkey finding its way back into the family of nations in the Arab world. Your thoughts on that in the light of Erdogan visit to Egypt, that these big rapprochement negotiations, discussions that were going on pre-October 7 can survive post-October 7?
Yes, Sean, first I want to share my opinion that
Please.
Before coming to Turkey's rapprochement with the regional powers, if you look at the recent developments in terms of Saudi Arabia shelving expansion plans for further increase in production, and demand declining, of course, in China. To the contrary, we were expecting demand to pick up in China. It hasn't happened yet. And also, most importantly, I think the signal coming from IOCs, international oil companies, and they are now heavily investing in low-cost oil around the world and buying new assets, because their target is something like the cost should be below $30, $40. For Total, it's below even $30. So it shows a tendency that they are worried about the future. Now they make good money in the current price circumstances, but they are also factoring in and projecting further demand decline and price going down. So they have to take their measures right now. It's already happening. So this is a signal. And regarding Turkey, since 2021, Erdogan has recalibrated his foreign policy vis-a-vis the region, seeing that he was more or less isolated in the region. So rapprochement started with Saudi Arabia, then UAE. I think it's going very well. And with Israel also it started. It was about to be crowned with a visit by Netanyahu a few days before Hamas attack occurred and following Gaza massacres. And so I think Israel relations still now going to be for a long time on the fridge. But with Egypt, the most important country in the Middle East in terms of population and influence in the Arabic world, I think this was an ice-breaking visit, because Erdogan didn't say nice things about Sisi when he took over from Morsi. And it took some time for confidence to be rebuilt. And now the agreement they signed, high-level strategic collaboration between the two countries, is quite important in terms of increasing the trade, also taking joint strategic approach vis-a-vis what Israel is doing in Gaza, defense collaboration in energy, especially LNG and renewables. So there are many areas of collaboration, but one has to wait and see, because you can sign tens of pages full of agreements, but what matters is the implementation. However, this is the first step. I think it's going to move forward. And then on Cyprus also, there is some movement where
Just
I don't
before we get onto the Cyprus piece, can Turkey together with, I mean, in Egypt, we had obviously the negotiation, the attempts to negotiate a settlement on Israel's war on Gaza. Can Turkey play a role in that? And what would that role look like? Supporting Egypt, or what is that? What's your vision or your thoughts on Turkey's role in this clearly very serious crisis in the Levant, in the East Med? And does Turkey have a role to find a settlement?
Well, I mean, as you know, Turkey is the largest power to reckon with in the Middle East and East Med. Therefore, if Turkey plays it smartly and in collaboration with the regional partners, paying attention to sensitivities, I think Turkey is bound to play an important role there. But there will be a role sharing or competition with UAE as well as Egypt. So I think this visit probably removes some of the clouds about the mutual suspicions between the countries. So now, if they are going to act together with Egypt, and it seems that Iran, Iraq, Syria not yet, but Iran, Iraq especially is quite keen to join the bloc. So there might be a regional sort of a grouping which will work together, which is easier said than done, but there is such an intention. And Erdogan, if he plays his hand well, not acting as if he's the leader of this grouping, but as a responsible member of this grouping, and I think win-win way, Turkey could play a quite positive role because it has good relations with Hamas alongside Qatar, as you know. It can influence Hamas somehow, as well as Al-Fat.
Well, I saw yesterday a rather sort of horrific commentary from one of the Republican candidates in the U.S. saying that, well, all the Palestinians can leave Gaza and go to the Hamas supporting countries like Turkey. So not it's kind of obviously a way of thinking in a certain part of the American body politic, but it's certainly one in the region, and where these regional powers stand on that issue of opening the doors at the Rafah crossing, the pressure must be building, but I don't want to go down that rabbit hole. Carol, I wanted to get your thoughts on where we are vis-a-vis the impact of what appears to be now a higher for longer rate cycle, particularly with the Fed. The inflation numbers have come in. The U.S. economy is still looking strong. Is that good or bad for oil prices and the outlook for oil markets that rates will stay higher for longer? Or does it have a bearing?
I think that our markets have already factored in the current scenario of rates, but where people are looking at these days is when will the rate cuts start? And lots of people are already betting on seeing several cuts this year, at least in the US, but also in other important economic regions, such as in the EU. But we keep on hearing from the Federal Reserve, from Powell and other people, that you should not make early bets on rate cuts. But it seems that on balance, we can expect to see those high cuts, those high rates, record high rates, maybe to start to ease sometimes this year. I don't know when. We still have to wait for more positive data to come, and not just a month or two, but something more convincing that you're on the right path. And this is when we can expect. How would that affect oil markets? As I said, I mean, high rates have already been factored in. Of course, when rates start to decline, that should provide a boost to economic activity, and that should be supportive of economic growth and oil demand. How much would that be? It's not going to be a boom overnight. It's going to be a gradual increase, but there are other factors than just depending on the interest rate. So the interest rate is one of the factors.
The reason I ask is because we had seen previously, you know, the fourth quarter, the end of the year closed out with this expectation from the markets of an early cut in rates, like i.e. March, and then significantly going from there 6-7 cuts through the year. The markets have backed away from that, but nonetheless, that scale of cuts would seem to indicate, to me at least, of a very serious economic downturn, and so that can't be good for oil prices if cuts indicate economic weakness.
Yeah, but if cuts are needed, if inflation has been tamed, that's why you use the interest rate. There's another way of looking at it. So if you use the interest rate to tame inflation, inflation is not good because it creates weaker, more economic problem than if you start to gradually wind down interest rate because you have achieved your mission. That's how I would look at it, more than necessarily the economy entering into recession, because the economic data so far is reflecting a good outlook for at least the American economy, and the rates the high rates are not needed maybe for too long because the central bank feels that it has achieved its mission. So it's not really like a clear cut. We can engage in a very long discussion about that.
So that's why I think it's sort of in this weird neutral space that cuts are good or bad. I mean, they obviously depend. Love is in the beauty's in the eye of the beholder and all of that. But it's not clear to me that it's 1 and 1 is 2 in this instance. Neil, I wanted to get your thoughts on comments earlier this week from the Saudi energy minister about maintaining idle capacity, and that why should Saudi Arabia continue to burden this very expensive infrastructure if it's not being appreciated, and the likes of the US, which he pointed towards, I'm not sure if he specifically said US, but he did say that if countries are just going to use strategic reserves every time they don't like the price, why should we maintain this very expensive emergency supply capacity? Your thoughts on that as a sort of a statement from the biggest oil exporting country in the world, and what that could signal going forward?
Well, the Saudis primarily have, of course, been sitting on significant spare capacity for as many years as most of us can remember. Nothing like as much as they were sitting on in the 1980s, of course. And of course, it does make perfect sense, because if oil demand growth in the next few years is going to be lower, growth lower, not demand, and there's still going to be plenty of supply from other parts of the world, the United States, Canada, Brazil, Guyana, and 1 or 2 others, then sure, yeah, why would you need to increase your capacity? Well, we've had the answer to that already a couple of weeks ago, and it is an entirely reasonable question. But on the other hand, what the Saudis, the problem the Saudis have is they don't seem to recognize, well, they do know this, of course. The United States does not have an oil minister. There is no central planning as far as oil production in the United States is concerned. It's an entirely private sector business. Production rises and falls depending on market conditions and as to whether it's profitable or not. Now, as far as the SPR is concerned, I've felt for many years now that since the United States domestic production, crude oil went up from 5 million barrels a day in 2007, I think, to 13 million barrels a day or so now, there is clearly no need to maintain a domestic stockpile such as the United States had at 700 million barrels in these new conditions when you have so much domestic production capacity of your own. And indeed, even before the drawdowns that the Biden administration made in 2022, which was a blatantly political act because prices are rising ahead of the midterms, even before then, under the Obama administration, the US had passed legislation to make phased drawdowns from the SPR because they recognized it no longer to be needed at 700 million barrels. My feeling is that as we move through 2024, if the oil market were to tighten as we move through the year, and I doubt that it will, but if it were actually to do so, and the price signals were flashing bright red as far as the US gasoline consumer is concerned, then I would not be surprised if there were more SPR drawdowns. And that is just a fact of life. And I'm afraid the Saudis and others just need to suck it up. It's a fact of life and get over it.
Okay. I wanted to also get your views, Mehmet, on, we had some news yesterday, India's prime minister here developing further infrastructure with the UAE providing a whole new warehousing facilities, etc., for Indian businesses to operate out of the Gulf. And of course, this comes a few months after the grand announcement at the G20 that India corridor into the Middle East and somehow connecting through to the Med and Israel seems like another universe now. But does a project like that still have legs? What's the India growing footprint in the Middle East and Gulf look like to you?
It is increasing, actually, because this is one of the primary goals of the Indian government. First for its own needs, but also counter China in the region. In that regard, I think there is a clear understanding between Washington, Delhi, as well as Abu Dhabi and Israel. Also, I mean, what's happening in Israel perhaps put this in cloud for a while, but there is a clear understanding that in the region, there is need for a power to counter somehow China's growing influence in the Gulf, including Iran and Arab Peninsula, as well as in the Middle East. So this first project that you mentioned, G20, during the G20, it was announced. I don't think it's going to go anywhere anytime soon. First, we were, of course, very skeptical about its financial size. Who is going to finance that? Then the route coming all the way from Mumbai to Dubai, then Riyadh and Jordan, Israel, then Greece. It's very complicated. Trains, ships involved. So it's not going to happen anytime soon. Red Sea crisis, of course, should be adding salt into the wound. But I think India is quite adamant, as they were doing in Central Asia somehow, but now they want to do it more and more in the Gulf as well. So how successful they are going to be also depends, of course, on India's power. But India depends heavily on imports, especially oil and gas coming from the region, the construction work and elsewhere. But it's difficult for India to compete with China, perhaps, where they have huge resources mobilized and defense collaboration, economic collaboration, bribery, corruption, whatever you name it. And therefore, I don't think that India will be a good fit for China, at least in the foreseeable future. But the US will be pushing together with India to reduce China's imprint in the region.
In the Middle East. Let's go to the survey question and get a view of the room on some of those points made earlier. What are the chances that Israel's war in Gaza could still spill over into a regional conflict threatening energy supplies from the Middle East? I mean, the markets had essentially discounted that as close to zero. But this, you know, the Israelis walked out of the peace talks in Cairo over the last few days. We've had, as Carol mentioned, the border between Lebanon and Israel. There was apparently skirmishes there yesterday, which saw Hezbollah rockets go deeper into Israel than they have over the last 4 months. Israel reacted, of course, as this tit for tat keeps going on. Is the oil markets or the energy markets in general discounting this possibility too much, as there seems to be no accounting for it in the current oil price? I'm just wondering what the view in the room and our wider network feels about the chances of this still happening. Close to zero, close to 25%, close to 50-50, close to 75%. This is still very likely, I suppose. That's what that's saying, closer to 75%. But where do you think this likelihood currently sits? And I suppose every week it might look differently. So we just assess it from what vantage point of this week. Carol, I also wanted to get your thoughts on the markets seem to also somewhat dismiss, not give too much credence to the Saudi energy minister's comments earlier this week of we're not sure if we still want to be a swing producer anymore. Your thoughts on those comments? Is that overreading them? Going forward to the end of this year when quotas have to be renegotiated? We saw Angola leave OPEC last December, the difficult meeting. So I'm just wondering, where do you think that statement lands about Saudi Arabia's place in the global energy markets?
Look, if I look at the production cost and the size of reserves of Saudi Arabia and its spare capacity, I think it would be one of the very few last standing countries, producers in the world as the energy transition accelerates. And we're still far from a scenario where we'll have this only like a tiny group of producers, but dominating the market. But I think I would have thought it's not just the volume of production that gives Saudi Arabia its power and influence on the market. It's primarily its spare capacity. But of course, you don't want to have too much spare capacity, as earlier you and Neil discussed, but not too little. So to lose that, not to have that, will take away from the influence of Saudi Arabia in oil markets. Now, of course, you can read it in different ways, but I would say Saudi Arabia's spare capacity will continue to play an important role. And that what makes it a swing producer, in a sense that it wants to continue to act as the central bank of oil markets, as they always wanted to do. And this is where it get their really major power and influence over the markets. So when you watch OPEC or OPEC Plus meetings, I listen very carefully and I watch very carefully what Saudi Arabia is going to do, because they are the one who can really influence the direction of travel for the group and for oil markets. So this is how I see it. Not only that, I would add one more dimension which people don't discuss as the energy transition accelerates, is the issue of carbon intensity. Saudi Arabia does not only have the low cost of production and the massive reserves, but they also have one of the lowest carbon intensity of their oil. So when other producers are going to leave the market in a greener future, Saudi Arabia's oil will continue to have an advantage on many fronts, including from a climate change perspective.
Neil, just to sort of follow on from your earlier comment about the fact the US doesn't need to rebuild those strategic petroleum reserves, which had grown up to above 700 million barrels. They're now, of course, half of that. But there has been a sort of an expectation in the market that they would rebuild them. And they said as much, well, the American government said they would buy if prices drop to 70 or something, but they never did. Should the market still expect that, or is that that horse isn't running in the race anymore?
I don't think I think that horse is still in the stables, gently grazing, and it's not an imperative for the US to rebuild the stocks, as I suggested earlier on. There is no supply shortage. I'm firmly in the camp that there is close to 0% chance of escalation in the Middle East affecting the oil markets, and I just don't think it's an important political imperative for the United States at this moment in time. And it's more likely if, as I said, if we go through 2024 and there are price pressures, you will find that the Republican Party will hammer the Biden administration about any price increases that do come through, even though they'll be the result of global supply-demand pressures. But the Biden administration will release if it feels it's in its political interest to do so. But I doubt it will happen, actually, because I just don't think there are the price pressures, the upward price pressures out there in the market as far as we can see through 2024. OPEC Plus is going to have to extend the cuts through the year. I think that's almost a given. And so I think
all of the cuts, like the voluntary ones, the Saudi exclusive, the
absolutely,
6 million.
Absolutely. No, and if you do believe that if you believe that demand is going to grow comfortably this year, let's say, not by the massive amounts that OPEC Secretariat are talking about, but it does grow comfortably. But on the other hand, we've got more expansion from the US, from Canada, Brazil, and various other places, Guyana, then the market will be quite nicely balanced. And that's what the supply-demand balance looks like currently going through the year. Builds in the early part of the year, tighter later on in the year. But, those numbers are going to change.
Mehmet, the earlier comment about the difference between the IEA forecast of global oil growth, demand growth in 2024, they're at 2.2 million. The IEA is at 1.2 million barrels a day. That's 365 million barrels of a difference for the year. But the idea that gap maybe revolves around your interpretation of how weak Chinese demand growth will be this year. It was quite strong last year coming out of COVID. Obviously, you'd expect that. But where is China at? You've obviously been a long-time China watcher. You're based there. You know what's your sense of the challenge that China currently faces? We had one commentator on yesterday saying that it's kin to a major depression potentially, given the challenges they're facing, demographics, real estate, debt. The things pile up on top of each other. How serious a moment do you think this is for China?
I think the biggest challenge in China, as far as I can see, because I was there a couple of weeks ago and talked to a range of people in the industry, is FDI is no longer coming as strongly as it used to, because FDI has been the engine of Chinese production and exports. And also existing foreign direct investment in the country, especially in the hinterland, are gradually some of them preparing to leave China, in the expectation that in the future, if there is going to be a confrontation between the US and China, they don't want to be caught in crossfire. of course, there are some long-standing investors. I mean, for example, Germany is still strong in China. They still increase their FDI, but the US companies, Japanese companies are increasingly in the mood of leaving. This is the biggest concern, and the Chinese are asking help for this. And also, I think money supply is in short right now in China. Many people expected that China was investing heavily abroad in minerals, mines, oil, gas production. No longer you have these Chinese companies having the same appetite. Therefore,
even on the Belt Road Initiative is kind of dead, or
it's not that, because it's already, I mean, it's the brainchild of Xi Jinping, President Xi Jinping. It's already enshrined in the Chinese constitution. It will continue. They spend up to now almost $1 trillion in Belt and Road Initiative. No nation on earth could do this for such interconnectivity. However, there are problems with Belt and Road Initiative because Chinese are operating on commercial basis, and they try to take over some of the concrete, tangible assets rather than giving loans and whatever to these countries. So there are controversies on this issue, but still, it's the only it's the only man in town in a way supporting infrastructure projects. But this is decreasing now, as it's not as strong as it used to be. So this is also part of a conscious US strategy to contain China, but also domestically make it quite difficult for Chinese economy to grow. That's also one of the explanations why there is less demand now in China for energy imports from abroad. And therefore, also, I think one serious concern the US has, I think during the last IEA ministerial in Paris, US Secretary for Energy clearly said that we are very worried about being over-reliant for critical raw materials and rare earth on a country which doesn't share values with us. It's interesting that she brings the value issue to this energy equation. Therefore,
yeah, that is certainly one. That's also quite an issue in the context of the current crisis in the Red Sea, because of also a lot of the material going up the Red Sea is renewable energy infrastructure and materials coming from China. But we'll have to leave it there. It's really a critical point. Where does China go this year? Close to zero, close to 25%, 50-50 in this room. We'll have to see where the wider market thinks of that question. And I say every week that might be a different answer. But Brent crude oil trading down very slightly in early Asian trade at 81.38. Thank you so much, Carol Nagli. As always, Mehmet and Neil Atkinson, thank you very much. All the best and have a great day. Cheers.
Thank you. You too.
You too. Bye-bye.